This is going to be a video over April the 28th, 2022. So here's the daily chart. As stated a couple of times, we had a bear breakout and a sell-off testing the March low. This bar right here, the 25th, was a sign of disappointment. That's a strong bull bar closing on its high, and if you're a bull, if you're a bear, you don't want to see that. That increases the chances of more trading range price action, and although we had a small second leg down here, closed out on a tail. It had a tail below, testing the March 14th low, which was the first target, the higher low down here. And on the very next day, you got a doji, so now it's a micro double bottom, down, up. And today gapped up and tried to close on its high around 4,300, but sold off. Interestingly enough, the midpoint, if you bought this low and you bought above this bar, the midpoint is right here. So some traders, in theory, they buy here, they buy more here, get out, break even. On the 5 minute, on the open, so trading range, do like that. And you can see the market broke above yesterday's high, immediately sold off. Reasonable sell below bar 1, stop up here. Betting on a trend from the open, more likely we'll go sideways and maybe get some sort of opening reversal. Follow through, but not a big body and a decent pullback. Some bears tried to sell 50% pullback at this bar. Bar 3, 3 consecutive bear bars. On the 15 minute, it's a big bar. You have to keep in mind that it's around a 50% pullback of this overall range, so you're getting into that zone where bears may take profit. Strong bear bar, probably not going to get a fourth bear bar, so traders may start looking to take profits, which they did here. Bulls bought that low, scaled in lower. So bulls are making money buying below bars. That doesn't mean you should be buying, but this is a sign of potential disappointment. Bad low one short, tried to go outside up, but again, it's a bull bar in a micro channel, not a great buy. Odds are you'll get a second leg down. Probably have to get to the moving average and maybe yesterday's close. Low one short, but tail still probably going a little bit lower, but possibly buyers below and a little bit more up. So surprise bar, big bear bar, probably at least a small second leg down, maybe forming a wedge. 1, 2, 3. Make it follow through. This could just be a buy vacuum test of the close. Big bull reversal bar. It's possible it's 3 pushes down, 1, pullback 2, pullback 3, or a failed breakout of this double bottom. So down, up, so it's a double bottom. This is the neckline. We broke below it, turned up, so reasonable, I don't want to say reasonable buy, but possible sign that the market's entering into a trading range. And then the market went outside up, testing back above these highs. Big bull bar, it's still a micro channel, so it's still a 1, 2, 3, 9 bar bear micro channel, first breakout. Probably better to look for a breakout pullback buy setup. And you can argue two-legged pullback, double top here. Bears, they want a bear breakout below the neckline and a measure move down, which will take you to here. So bear breakout, break below the neckline down to here. Probably won't get that. Big bear bar, however, big bear bar here, bad follow through. Now this is the third push. 1, pullback 2, pullback 3. So 3 pushes down. May find buyers down here. Follow through, probably at least a small second leg down, but again, you're getting close to the bottom of the range. Bulls, they bought these lows, scaled and lower. They may buy here, scale and lower, betting that the breakout's going to fail. Disappointment, and some bears will look to get out break even. They sold this close, disappointed, and may try to get out break even. It's also low one short. So now we have 3 pushes down, 1, 2, 3. Weak doji bar, but after a couple legs down in the trading range, you have to question if we may have a couple legs up. So it's okay to get out shorts above this bar. Most traders should, instead of risking the stop up here. The reason why traders would get out is if you're If you're short and you're willing to hold above this bar, which is this line right here, in theory your target's up here, or excuse me, your stop's up here, which makes your target down here. And you have to ask yourself, what's the probability that price is going to go all the way down to here before it goes up to here? Well, if this is a trading range, this may not be 60%. And if that's the case, then we could easily rally back up to here and possibly up here. So it's bad risk reward, and the probability is not 60%. So you have to tighten your stop. You could tighten it to here, but it's still the overall same issue. The odds are maybe it's 50-50, it goes to here before it goes to here. So it's a bad trade. But if you tighten your stop to above this bull bar, your risk reward is phenomenal. If you get a bear breakout, your probability is that you're going to get stopped out. But anyways, that's for another topic. So micro double bottom, the bulls. It's a micro channel. First let may fail. Bad low one short. The bulls were able to prevent this bar from triggering, or they were able to prevent this bar from. Let me restate that. The bulls were able to prevent these bulls. The bears were not able to stop these bulls out. Sorry about that. I had to pause the video. But what I was saying is typically the bulls were able to defend this stop, so it's a sign that the bulls are strong. Now we have a second entry buy. Bulls may get out above this. Bears may get out above this bar. Still stop low here or here. Follow through, more follow through. So probably always in long. Odds are we're going to get at least a small second leg up. And very strong breakout. Stop far away. So if the risk is too big, some traders it's by the close, some traders may get out, 5 or 6 points below a bar. And look to buy again. So deep pullback, bear trend. So here is the trend line. We broke above the trend line. This is a higher low major trend reversal. It's 50% pullback. Some bears sold down here. They may scale in, look to get out 50%. Other bulls, they know this bar is big. Therefore, it's kind of like this. This is a big bar. Traders want to reduce the risk. Therefore, they try to sell a pullback. Well, this is a big bar on a different time frame. Traders want to buy a pullback. And also, they know it's in a trading range. So typically when you have a trading range and your risk is something like this, that's above the trading range. But if one tries to buy, let's say, a 50% pullback, here's the risk, bottom of this bar, somewhere in here, and the reward is twice the risk. Or you could argue it's a 1-to-1. So if you're buying here, it's a 1-to-1 from here to here. Wrong button. Okay. So pullback, odds are bulls are going to buy it, starting to go sideways, trying to break above these highs, breakout, follow through, testing the open of the day. Consecutive bull bars, probably going higher, breaking above the high of the day, clearly always in long, and we're just vacuuming up to support. Now when you see a move like this, at some point it's just wise to take profits. We could go up another 30 points. However, the risk is huge. You're far away from the moving average. Better to lock in profits, because at some point, even though that happened, you're going to get this. And this was too climactic, and eventually, broke above the top of the channel, and you call it a wedge. 1, 2, 3. Maybe the channel's here, becoming parabolic, and we sold off into the close. So overall, daily chart, probably going to close this gap. The bears are trying to get down to the February low. They hope they can break below it and that we get a measured move down, maybe testing 4,000 or testing 3,600, which would be a measured move of here. The bulls, they know the market's been in a trading range. They see this kind of like over here. They hope the bears are disappointed. We'll gap up and rally, closing this gap up here and continuing the trading range price action.